Well, Brent, a real simple question. What you just heard us go through over the last 4 minutes, what do I do with an investor who is in cash, knows he shouldn't be, or she knows she shouldn't be? How do they deploy cash given this news flow?
Well, I think I would probably first start by telling investors they should never overemphasize politics in their portfolio construction. And so if I take you back and pull you away from the emotions of politics, and certainly elections are important, but if you look historically, to me, the bigger important part of what happens during an administration's election is what they inherit. And what they inherit is a business cycle. Typically, if a president inherits a business cycle late in the cycle, the Federal Reserve is tightening and they have subpar returns. The average going back to 1960 is around 6% market returns if they inherit a business cycle with no slack left. On the other hand, if they inherit a business cycle that is either early or mid, the returns are much more. Indeed, there are 10 of those elections that occurred, and each one of those 10, at least 9 out of 10, I should say, the returns during that administration were double digit, with those in early cycle around 14%. Now, I'm not suggesting it's going to be 14%, but I think if we're coming out of a recession, we are still at least early to mid, and the chances of having a decent market return, at least based upon that one metric, are pretty good, especially when you consider that no matter who is elected, they are receiving a Federal Reserve that isn't tightening rates for as long as I can see. And so that's the one thing that won't change. That's the certainty you have. And yes, the Federal Reserve does still have power over what happens in the markets.